Hello, everybody. This is Arya Akhtar. Hello, hello, hello. This is Arya Akhtar. Hello. In last lecture, we finished unit number 10. Today, we start here cost accounting concept and method. Three, two, two. Before that, we just finished this chapter. Very important chapter. Sorry for disturbance. Yes, we start here. Yes, this is 10th unit. Financial statement analysis refers to the study of financial statements. In financial statement analysis may be defined as a purpose of identification and this is balance sheet, income statement, and the cash flow. So these three parts are financial statement. Important points. The objective of financial statement is provide the data about the financial position, performance, and the cash flow of enterprise. Financial statement analysis use and this data is generated information about the relative performance and its trades. So the financial statement analysis refers to the deals with study of financial statements. In this chapter, we analyze various techniques. Uh, the two analysis are there, horizontal and vertical. Comparatively, the statement and trend statement, common size of statement, ratio analysis. They given advantages and disadvantages, and given one example. They given various examples. After that, vertical analysis and how to follow the vertical analysis is given here. After that, very important part is ratio analysis. And ratio or analysis, the given formula. And we for the use of formula, we calculate the effect of money like that. Current ratio, current assets divided by current liabilities. So they indicates the ability to meet current maturity obligations. Means with the help of these ratios, we can plan our future and our present simultaneously. These ratios are very much clear idea about our financial position. So these can help very easily with the hypothetical intention. After that, quick test ratio is quick asset about divided by quick liabilities, indicates the ability to meet immediate maturity obligation. Cash ratio, cash means cash plus cash equivalent divided by current liabilities, indicates the proportion of current obligation which can be hit with the cash. After debt equity ratio is equal to borrowed fund divided by owner's fund or borrow fund divided by total fund. So these are the very important ratios which we calculate. See, in this example, they given uh, one balance sheet. For that, into September 2008 and 2009. We compare with that, and with the help of this, we can calculate the exact ratio, debt upon equity, which is indicates in these digits. What is debt and what is equity? They given here. So 54% for 2008 and 55% for 2009. It can be observed the debt equity ratio is almost same. There is a higher proportion to debt compared to equity. This shows the company has high level financial risk. So it indicates very easily. After that, they were given one by one ratio. A proprietary fund is equal to net worth divided by total asset, or proprietary fund divided by total fund. After debt equity, proprietary fund and investment coverage ratio. After this indicates the P&L profitability ratio, which is EBIDT, means in income set, EBIT divided by sale into 100. After EBT percentage ratio, EBT ratio is equal to EBT into 100 divided by sale. Earning per share is equal to PAT, which is profit after tax, attributed divided by shareholders average number of equity shares. So this is earning per share ratio. After ratio, return ratio, ROI and ROE, return of capital employed and return on investment. They given various ratios in table format. You can easily read it, and you easily calculate it. After that, the given working capital management cycle. This is operating cycle. Cash after raw material, work in progress, work in finished goods after sale, um, accounts receivables, and after this is converted into cash. So this is the working capital cycle. So they basically given various ratios in your textbook. You can just read it and very carefully calculate them in your examination. The given various exercises. After this ratio analysis, we can move on cost accounting. Cost accounting is basically the third little bit different situation. In this, we can calculate costing point of view. This cost effect is very important in our business. So cost accounting concept. In this concept, they introduce the cost accounting. In this chapter, we cover cost centers, cost unit, elements of cost, classification of overhead, method of ordering cost, job cost, batch cost, contract, operating cost, process cost, and operating costing. Cost sheet, solution of illustration, and summary. So these are the very important factors in this chapter. Firstly, the cost is the cost of management has defined as the process accounting cost for the point in which the expenditure is incurred to the estimate of its ultimate relationship with the cost center and the cost unit. It is a wild sense. It is embrace the preparation of statistical data, the application of cost of control method, and the statement of the profitable achieves carried our or or planned. This is definition. Cost center. Basically, cost center is a location, person, and the item equipments for which the cost may be ascertained and the use of the purpose of the cost center. One sec. Personal information and in personal cost center. The cost center in which the contain the personal or a group of person is called a personal cost center, like purchase manager, sale manager, etc. These are the personal cost center. Cost unit. The cost unit is the unit of the product you or a unit of service in which the cost is ascertained by the means of the allocation, appointment, and observation. Element of cost center, material, labor, and the overhead, direct, indirect, direct, indirect, indirect, direct. These are the elements. Material, the substance from which the product is made is known as a material. It may be in a manufacturing states. It can be direct as well as indirect. The direct material, all material which become an integral part of the financial product, in which can be conventionally assigned a specific physical unit to trends a direct material. All material or of components specifically purchase, produce, and perquisites. So material is the material which is direct or indirect. After that, labor is a live part. It is a human effort. Uh, this is not this is live. This is live atom. Like labor means the two way, direct or indirect. The direct labor in which take the active or a direct part in production. Indirect labor is the employee for purpose of carrying, but they goods produce and service provided indirectly. After that, overhead. These are the expenses which can be directly, conventionally, and wholly allocated to specific cost center or cost unit. Examples such as expenses are higher for special machinery required or the particular contract. Cost of the work work occur in connection with the particular job or contract act. Indirect expenses, these expenses which cannot be directly conventionally and whole allocated to the cost center or cost unit. Example of each example are rent, lighting, insurance, and charges. Classification of overhead. The indirect material used in the factory, such as lubricants, oil, consumable stores, etc. The indirect labor, such as a gatekeeper salary, timekeeper salary, and manager salary. Indirect expenses such as the factory rent, factory insurance, factory lighting, etc. So these are the factory, and these are similar to office also. Selling and distribution overhead also one of the part. Classification of cost, Pro- product and period cost, contribution of non-contribution cost, replacement and oriented cost, input and sunk cost, fixed variable and semi-variable cost, opportunity cost. Method are specific order method. They give an explanation. They gave in various example. You go through it. In 12th unit, the managerial costing and the CVP analysis, which is basically for the cost centers. In this, cost material is defined as a change in aggregate cost due to the change in the volume of uh, production by one unit. For example, if total number of unit produced in 800 and the total cost of production is 10,000, if one unit has additional produce, the total cost of production may become 10,010. If the production cost is indicates the one unit, it unit the total cost may be 9,990. Thus, the change in total cost is 10. Hence, the margin of the cost is 10. The increase and decrease in the total cost is the amount become a variable cost and analysis remain constant as per the unit base. The marginal cost has been defined as a assignment of the cost and meaning measuring the impact of profit of the change in the volume of output type and output. These subject to be assumptions and that the fixed cost will be remain unchanged irrespective of the changes. Thus, the marginal cost hold freely the ascertain of the marginal cost and measuring it impact on a profit. Allocation made in a process of the volume and the type. It is a fact of technique the costing in which only variable manufacturing costs considered as while are determining the cost of the goods sold and also for valuation of inventory. The fact is technique in base of the fundamental principle that total cost can be divided into fixed and variable. So these are the important. In this unit, we can observe the marginal cost, observe absorption cost and marginal cost. They given one difference. You just go through it. After that, they given various problems. Yes, they given one diagram. They one diagram in production sale. It explain the horizontal and production and the volume should be have the vertical axis and sale cost of amount are known. The assumption of break-even point, BEP, the concept of break-even point is based on a following assumption: the production and sale are the same, which mean that thus much a product is sold out in a market, thus there is a no inventory remain the end. The value variable cost varies with the production can change. It is the same production that of the production, hence it has a linear relationship with the production. In other words, variable cost per unit remain the same. Selling price per unit remains same irrespective of the quality sold. Limited break-even point and break-even point exactly useful in decision making regarding the production level indicates the level of production where there is a neither any profit nor loss. However, this is based on a assumption that the variable cost per unit, sale price and per unit and the fixed cost remain the same. Thus, there is many changes in this variable. The break-even point will be given misleading to result. The given summary. Unit number 13, standard cost and the variance analysis. The introduction of objective and the description is given below. Introduction: standard cost is defined as a predetermined cost, which can calculate for management standards of the efficient operation and the relative necessary expenditure. It may use on base of the price fixation and the cost control through various analysis. Their comparison with actual cost and analysis varies in cause of the point. It indicates from the definition given below. The following features of the standard cost to standard cost in a emerge. Feature of the standard cost. Standard cost is the following are the features. Standard cost is a pre-planned and predetermined cost. Standard cost is not a estimated cost. It is calculated as per taking consider the management standards of effective process your operations. After that, variance analysis. Variance is difference between the budgeted and actual level. The variance means difference. Cost variance is direct material cost variance, direct labor cost variance, and overhead variant. Direct method of variance. This is type of direct material is various expand here, and the first one directly material cost. Uh, Material cost variance, which is equal to the difference between the standard cost and the direct cost. The specific of the output achieved and it actual cost is directed price with the standard quantity for equal output and the lead actual cost is computerized by the multiple actual price with the actual quality. The direct material cost variance, the total standard cost of the actual you output, the total actual cost. So the standard price into the standard quantity for actual output less actual price into actual quantity. They given various terms in of DLRV. After that, they given overhead variance. Overhead variance is overhead cost variance and fixed overhead cost variance. So variable and fixed are two different terms. After that, standard cost and certain circumstances, they were given various example and solution also. You just go through it. They given different industries and the key factors are here below. Motor car, the selling of demand. Aluminium is power. Petroleum is supply of crude oil. and the electro option is skilled techniques. So these are the related key factors. After that, the given type of budget classification on base of time, on function and the capacity. These are the various different type of budget. First is long term, short term and current budget. After that, financial subsidiary budget. After that, meter budget. After that, fixed budget and fluctuating budget. These are the type of and classification of budgeting as per time. They given various example of that. So these are the various questions. After that, introduction of financial management. So these are the cost cost accounting, and now we started a year in financial management. Financial management means the science of money. It is studied for the principle and the methods of obligation control of money for those who have saved it, demanding by those control in phase. However, the optimist book introduced business finance definition and finance. It is a determined area of the set of administrative function in which organization is related to the agreement in cash and credit, so that the organization may have the main carry out it is objective satisfactory position. It is similarly term in the financial concerned with the planning, rising, coordinating, administrative, and fund use in a business. The finance is the activity concerned with the rising the administrative fund used in business. So they given definition. Just read it very carefully. Nature of scope of finance manager. The term finance management has emerged uh, from the generic discipline of the management. In order to understand the financial management, it is better to start with an understanding of term management. Management simply put it all about a securing the option use of the resources at the disposal of financial towards a and dream of same predetermined goal. These resources are many kind of such as human capital, production, machines, distribution and demand, and etc. The resources are put under the change of these respective function and their management control. So this is the nature on scope of the financial managers. After they give an objective, next chapter is financial managers and the source of finance. In this we focus on financial markets, money market, capital market. In capital market, long term, short term, and international sources, and these are covered in here. Cost of capital and the capital structure. The unit in this unit, finance is an important input for any type of business, and the method of working capital of the performance investment. So they given the figures, and we can work out different. After that, the leverage. Leverage is operating, financial, and combined leverage, which is given below. The three different formulas which can we calculate very easily. We just go through it. After 19, the capital budgeting. Capital budgeting is mainly for payback period, accounting rate of return, ARR, NV, NPV, internal rate of return, profitability index. These are the various techniques which can calculate the capital budget. You just go through it. So these are the various example for capital budgeting. After that, the main chapter. One sec. So these are the various ratios and leverage ratio, financial structure ratio, and very more. They can easily make up such terms in these financial managers. Today we stop here.